Moses, great to have you.
Thanks for having me.
So we've known each other for a while. You have a really impressive real estate portfolio. You talk a lot about it on X, formerly Twitter, and a big property management business. Can you give us a sense of kind of the scale of the business and what's going on?
Sure. I mean, I just want to say that compared to plenty of real estate businesses, we're minnows. But I'm proud of it. We built it from nothing. So we have a portfolio of roughly $200 million worth of apartment buildings, all in the city of Los Angeles, and all acquired since 2012. And then we manage a total of 1,100 units across around 145 buildings. We own 400-ish units, and then the other 700 are owned by third-party owners.
Okay. So the point of this podcast is to teach people how to invest. And my hope is today that by the end, folks know what it takes to buy an apartment building, what it takes to build an investing portfolio. So maybe in that light, can you tell me a little bit about your first deal that you did?
Sure. Well, the very first deal that we did was one that I bought with my brother and parents. Interestingly, with the down payment that came from the sale of my great-grandfather's last building. So it was really like a true family capital type situation. The backstory is that we had been looking, my brother and I, to buy a duplex for us to live in. This is in 2007-ish. And all the pricing was just nuts. Like the GFC was had not quite started yet, but and so the pricing was ludicrous. And it was obvious even to our naive eyes that it was better to rent those apartments than to buy them. So my brother, though, stumbled across on the MLS a guy who had bought a derelict 16-unit building over on the east side. And he had renovated it and run out of money right at the end. And so he was desperate to sell. And so we were able to make a deal to buy that building for a price which was pretty reasonable relative to everything else that was going on at the time. I mean, if we had waited 6 months or a year, we probably could have bought it a lot cheaper. But it was a reasonable deal. And crucially, and we could talk about what reasonable means. But crucially, the bank that we borrowed the money from was pretty conservative. And so we ended up, quote unquote, over-equitizing. And I think we basically put down 35% of the purchase price. And the result of that was that even though the rental market subsequently tanked during the GFC, we had enough cushion that we were able to make it through. So it was sort of unpleasant for a little while, but it was okay. So that was the first deal.
Where does over-equitizing begin? Like, what are the norms for
Good
people
question.
investing in real estate? At least in Los Angeles, and things can vary, and also, as well, I'm sure we'll get into this a little bit, what you can do in terms of how much you can borrow is governed by two things. There's LTV, so loan to value, and then there is also debt service coverage ratio. And so the standard for commercial apartment loans, so in other words, anything with 5 units or more, the maximum LTV from like a traditional lender is going to be in the range of 75% of the purchase price. But crucially, that needs to also hit usually a 1.2 or a 1.25 debt service coverage ratio. Which means, like, if I need to pay $100,000 of debt in this year, I need to be making at least $125,000 of
Correct.
net income?
Yes, net operating income. That's right. Yeah, you need exactly $1.25 net operating income for each dollar of debt service. Now, if you in today's environment where rates are very high, at least compared to the last like 10, 15 years, and prices have not come down, you run into situations where if you purely focus on that 75% LTV number, you're going to think that you can borrow a certain amount on a deal, but in fact, you'll be constrained by the debt service coverage ratio. So the conventional numbers are 75 and like 120 or 125 DSCR, but
these days, because of the DSCR, the actual loan that you can get, at least in Los Angeles, is probably more like 65% LTV.
Okay. And on that first deal, did you know anything about real estate, or how did you guys decide what a good deal was?
Yeah, good question. So our parents had always, for our whole lives, owned like a few small apartment buildings. So, and when I say small, I mean like, 4 units here, 6 units there, and really unsophisticated in terms of how they thought about the deals financially. And that wasn't a problem. This was in upstate New York, in Troy, where honestly you basically could get buildings for free. In fact, my father literally got one for just paying the back property taxes, like an abandoned commercial building. So they weren't like sophisticated in terms of how they were. They didn't. My parents still, if you ask them what IRR was or something, they would have no idea.
Neither do I, by the way. Nobody knows.
So they were not sophisticated that way. What they were relatively sophisticated at, I would say, for the time and relative to other mom and pop owners, is they were willing to do renovations. And my father's a sculptor and generally just has good taste. And so I would say that the units that they made, or the renovations that they did, were like stylish and good. So like people, generally speaking, even though when I was growing up, Troy is was not a cool area. It's become cool now, but even though back then it was not cool. But there were enough like university professors and grad students and other people who, were educated and had some taste or whatever, who appreciated that and for whom my parents' units were kind of like interesting, that they could make a nice business out of it. And then I would say they were good at, both of my parents are, particularly my mother, are like really high conscientiousness type people. So they're just like really, when they had a vacancy, they took it seriously, they filled it, they were really good at the bookkeeping and making sure that things were fixed on time and all of that stuff. They're pretty fair with the tenants, I would say too. So in other words, they were not sophisticated financially, but I think relatively speaking, they were sophisticated operationally, although I don't think that they would have thought that they were sophisticated operationally.
Yeah. I feel like I meet a lot of real estate investors. I meet some real estate investors who are spreadsheet junkies and that's just how they operate. And then I meet some very, very successful real estate investors who are just intuition animals. They've never once looked at a spreadsheet.
Yeah. I mean, you can get hurt that way, but for a long time, and I'm about to say something which you should take with a gigantic grain of salt. But you honestly, in Los Angeles, a lot of people use a metric called GRM, which is just gross rent multiple, and they kind of get a feel, if you've been doing it for a while, and particularly if you own a bunch of buildings, you can kind of use gross rent multiple to back into what you think the yield is going to be on any building. So what I mean by that is basically people will be like, look, for this kind of building, I'm willing to pay 10 times rents, 10 times annual rents. Okay. And on the one hand, that does not sound particularly sophisticated. It's like, obviously it's like one of the most brain dead things you could think about doing. Cause of course, like what are the expenses? Like what's the margin, et cetera. But if, it's one of those things where it's like the midwit meme.
Midwit.
Midwit meme, exactly. Where it's like you get sophisticated enough and you're used to looking at enough P&Ls. You can be like, yeah, actually for a building full of 1 bedrooms, I'm willing to pay X GRM. And for a building full of 2 bedrooms, I'm willing to pay Y. So anyway, it's a long way of saying that when we looked at that first deal, it was like, and we could talk more about it because it was kind of interesting, but it was an empty but renovated building. And relative to what we thought we could get in rents, the purchase price seemed reasonable.
And you had to put more money in to finish it, or is it done already?
We had to put a little bit of money into finishing it. It was a crazy story. So this guy had really tapped every single source of capital that he could buy, like credit cards, you name it. And in fact, and then he had run out of money before he could finish. And he so what happened is he stopped paying his subs, who were doing the people who were doing the work, and so he went into penalty interest on various loans and everything that he had, and so and he kind of like fell. Honestly, this is after we went in contract. He sort of like fell off the face of the earth for a couple of weeks or maybe even months, and so the net result of which was, in order to be able to close, he was underwater. He was a little bit underwater.
And in order to be able to close, we ended up having to loan him $15,000 as a fourth trust deed, like a fourth position loan on his personal home, for him to take that 15, put it back into the deal, get the numbers to balance so we could close. And of course, my lawyer at the time was like, you should just write that 15K off, like treat it like part of the purchase price.
Yeah.
In fact, interestingly, like I want to say 10 years later, actually more, like 12 or 13 years later, we get a notice or I get an email from a title company basically being like, hey, this guy is about to refinance his house and we need a payoff demand for that $15,000 loan. And I was like, well, this thing's, I mean, according to the terms of the loan note that we had written, he was actually in penalty interest because he never made any payments on it, of course. So he was in penalty interest on the whole thing. I think we were like earning 8 or 10% interest on that 15 grand for like, whatever it was, 13 years. It actually worked out to like a pretty good investment. Yeah. But yeah, so we closed, and then we did have to finish some work. And we didn't know anything, so we overpaid on the work that we did and everything, but it worked out okay. And then we had to go through the process of tenanting it, which is like its own story. I don't know if you want to go down that path.
Yeah, I do in a second. So how much of that, I'm curious, like what amount of risk was that for you? Like how much of your net worth or how much of your liquid capital was that 35% that you and your brother had to, your brother, right? You and your brother?
Well, my parents put up the money.
Yeah.
I honestly didn't have a net worth at that point. I had gone to grad school immediately after college, and then I went at London School of Economics, and then I got a job in banking in London. But this was at like a tiny boutique bank, and I was basically spending everything that I earned. And so when I came back to the States in 2007, I had maybe a little bit of savings or whatever. So this was really like family money. In terms of how, it's actually interesting to think about what percentage of my parents' then net worth that represented. My guess is actually it's a pretty significant portion, which I honestly never thought about this before. I would say it's on the order of 15% or something like that of their net worth at the time. But it was money that had come from my great-grandfather to my grandfather and then to my mom. So I don't know if I don't know how they thought about it. I mean, I guess they thought maybe it was like found money a little bit, so they were a little bit more willing to take risk than they would otherwise have been.
What is the difficult part of tenanting? From my very amateur perspective, I just bought a building, 4 units in LA. It's newly renovated, posted on Zillow. I don't know if you guys had Zillow back then. And it's going to get tenanted. They're going to send me a monthly check and I'm done. What was your guys' experience?
Yeah, so our problem was that we bought this thing with 16 empty units.
Oh, 16 units.
Yeah, and it was empty, and we had a mortgage payment like coming the next month, basically. So we did two things. The bank had forced us to hire a management company, so they went to work trying to tenant it. They honestly struggled to get the rents that I wanted, that we thought were achievable there. And so what we did was there's a big nonprofit across the street that provides care for teen mothers. And we reached out to them, and I kind of, looking back at it, I'm actually kind of impressed with myself that I had the gumption to do this. Sort of reach out to them and we're like, look, like, do you guys need housing? We've got all these apartments right across the street. And fortuitously, they did. They had launched some program where they were trying to help these women transition into real life, like moving off their campus and into just normal apartments. And so we ended up doing a deal where we leased 8 of the vacant units to this charity on a master lease. So they were responsible for paying the rent. Now, and then our management company took responsibility for leasing the other 8 units in the building that were not covered by the master lease. Now, here's the problem. Teenage mothers attract a certain kind of guy who likes to hang around with them.
Okay.
And those guys were hanging out in the building. They had come to visit the women who were living there and the girls who were living there, and they would hang out. And so there was some, let's call it culture clash between those people and the tenants that we wanted to rent the other units to. Yeah. And so that made it hard to rent the other units. And that's
one of the lessons that I've learned is this building was in a slightly marginal location. It's got better now, but at the time it was a little marginal. And one lesson is that you can actually run a nice building with nice tenants in a marginal location, but you have to be really careful about tenant selection. In other words, you can't allow whatever chaos is going on in the neighborhood to come into the building.
Right.
People will tolerate, for the right price, a certain amount of chaos outside their building, but not inside. They want to feel like the inside is a safe haven. And so the mistake we made was kind of bringing a little bit of that chaos into the building.
Right.
And so over time, what we did is, as those women kind of, let's say, graduated from the program, rather than having the charity refill the units, we just like rented them conventionally. So we filled the building up relatively quickly, but which was good from a paying the mortgage perspective. But it really took probably a year and a half before we had it like stabilized with, like the kind of tenants that we would want to have in the building.
Were you just getting calls from people just complaining about like people loitering, or is there just like incidents in the building?
Both. And actually I lived there for a minute, maybe somewhere between like 4 and 6 months, which by the way is also a mistake.
Why?
Well, you don't want to live in your own apartment building. It's just like, or if you do, ideally the other tenants would not know that you're the owner.
Because they come knock and they're like, hey,
my stove isn't working. And I'm just like, call the management company.
Yeah.
Like I'm not, but obviously people don't like that answer, understandably. Right. So it's just not a good situation. So it took a while to kind of get it sorted out.
I imagine one building didn't replace your full income from your job, or did you quit?
Oh, no.
Yeah.
At the time, I had started a very dumb tech company with my brother, and that was paying my salary for a while. And then it became, two things happened. One is GFC happened, and so real estate started to go on sale. Two, it became obvious to me that this company that we started was not going to be the thing that like made my fortune. So I was going to have to do something else. And I was already like 27 or something like that by this time. And so the real estate starts to get in trouble. The head of the management company that the bank had forced us to hire came to me and said, look, I have this guy who screwed himself up on his loans and needs to sell. I know you just bought this building. Would you like to buy this other one?
Nice. Now you're a buyer in the market. People come to you.
Yeah. And by this point, the wheels had really started to come off. This guy who owned that second building was really in trouble. I knew at least a little bit by that point about the business. I mean, we had done some renovations of that first building. We had tenanted it. We had sort of re-tenanted it. And so I knew enough. I mean, my underwriting for that second deal was still very naive, but he said 145. I looked at the numbers. I said 125, and the guy said, great. And I was like, I don't have the money, and I had to get the money. Yeah. And that's kind of that's when we sort of, I would say, we went from like just being like a family mom and pop landlord to like starting to be more of like a private equity type arrangement. So
I assume you went back to the same bank. You're getting a 65% loan to value.
No, we didn't get a loan at all. Actually, luckily a good friend of mine from boarding school was at that point making a fortune running a high frequency currency trading hedge fund, and was looking for places to put money because as you may recall, it was really scary during the GFC. Like if you had cash, like financial institutions were going bankrupt. And of course, if you're talking about a couple $100,000, you're under the FDIC insurance level, you're fine, right? But if you have like $10 million or $20 million of cash, like what do you do with it?
Yeah.
I remember still to this day a moment with him before where he had a bunch of money with one financial institution, and rumors came out in the market that they were going to go bankrupt. And in that scenario, like what you're just sort of, I think you're an unsecured creditor to a gigantic, complicated bankruptcy. Yeah. And so he was like desperately for a few days, like trying to get them to wire whatever it was, $10 million or something out of his account there.
Yeah.
And I think fortunately,
that when First Republic was going down, we were like, oh shit, are we going to lose everything that we built?
Yeah. And I mean, this was, I remember that too. That was a terrifying few days. This was almost like worse because it wasn't a bank. It was an insurance company basically. So it was like there really was no federal anything. I mean, with First Republic, there was sort of like an implicit whatever from the FDIC, but yeah. So anyway, so when we came to him and said, hey, look, we have this building we'd like to buy. I think his view was, I trust these guys. They've already done this once. They're from a real estate family. They've done this once in LA with their own money. I don't have anywhere else to put money that's that great. And I think, I don't know, let me, another aside. I don't know if you recall, but when interest rates so the Fed responded to the GFC by putting interest rates to zero. And a lot of smart people were like, oh, this is going to result in a lot of inflation. It's comical because it did happen. The next time they put it to zero during COVID, it did absolutely sparked a huge inflationary spiral. But after the GFC, it did not. But at the time, people were expecting it. And so the conventional wisdom when confronted with, the prospect of inflation is to own hard assets. And so from his perspective, it was like, okay, these guys, the real estate family have done a deal themselves. They're coming to me for cash. I have somewhere to put cash, and it's hard assets, like an apartment building. Los Angeles, like, you're probably likely to maintain its earning power even during an inflationary period. There are all kinds of problems with that set of assumptions, which we can talk about, but that I think that was his thinking. Yeah. And so he put up all of the cash for us to buy that building and start to renovate it.
Wow, timely.
Yeah, and part of the other thing that I think allowed him to get comfortable with doing that was that our agreement with him stipulated that we could not use leverage. And so, which is crazy, like in real estate, not using leverage is nuts. I mean, people are just like, look at you like you're crazy if you say that. But I think what he was thinking was, if you don't have leverage, what is the risk exactly?
Right.
Like, you own an apartment building, and you might have guessed wrong on the purchase price, you might have guessed wrong on the rents or what it costs to renovate, but fundamentally, like, no one can take it away from you if you don't have a loan.
Right.
So it's hard to see how you go to zero.
Yeah. Interesting.
Yeah. So I think that is what helped him kind of like trust us.
And I think I see you write about this quite a bit. Your guys' philosophy is still to over-equitize deals or go pretty heavy in the equity versus the debt. Is that right?
Yeah. And I mean, I have always tended to be pretty conservative with use of leverage, definitely on the way in. My thought process historically was, look, you buy all cash, you renovate all cash. Once you have the building fully stabilized, your new higher rents, then, I have been much more open to using a lot of leverage. And so we, traditionally what we've done is like go in all cash, get the thing sorted out, then go put a big loan on it, take the cash back out, hand it back to the investors. And now we've got this building that is effectively like a cash machine. Like you have your capital out and the building's still producing cash flow every month. And that's worked pretty well. I would say that in retrospect, I think that I wish that I had been even more conservative on doing those cash out refis.
Oh, really?
Yeah, because this is a weird problem with the a sort of a misalignment in the real estate private equity model, which is to say that you're incentivized by the standard kind of pref and promote structure to return capital to your investors as quickly as you can. So you want to like lever up and return their capital.
Yeah.
The downside, of course, is that you're highly levered. And as you know, over the last, about whatever it was, 2.5 years ago, we entered into a new interest rate regime. And so despite the fact that we have like long-term loans and they're fixed rate, and we've almost entirely avoided even balloon repayments. So like our loans, when the rate comes unfixed, you can still continue to amortize them. Just a new higher
You're paying
rate.
Monthly both principal and the interest.
Yeah, and
just
so
like a mortgage.
Yeah, so I think in a lot of ways we were pretty conservative about the leverage, but even still, like if rates remain where they are over the next, let's say 2-3 years, 4 years, I still have to refinance my portfolio. These are not 30-year fully amortizing loans. Like you have to refinance. Luckily, rents have come up a lot in most cases. So I think it's probably gonna work out okay. Yeah. But it's gonna be pretty painful.
Right.
Like it, and so I think
I mean, it's hard. You would have had to be pretty far-seeing, I think, to, in my model, to really minimize the leverage, even at stabilization. So I think that was the right call. I think if I had said that to my investors, we could return all your money, but we're not going to
do a little less. Yeah.
Yeah, they kind of would have been like, many of them would have been like, "What are you doing?" Kind of.
You would have done a lower LTV.
Yeah, we could. I mean, like exactly. We could have, and I think. So I think the decision making was still right. But it's easy to Monday morning quarterback yourself.
Sure.
Yeah.
Let's talk a little bit about your focus on LA, because I meet a lot of real estate buyers who maybe started in California and then at some point got fed up and moved abroad, or abroad meaning like Arizona and Nevada. Yep. How do you think about your focus on LA versus going elsewhere?
Yeah, well, here's another area where I feel like I could, should Monday morning quarterback myself. So, LA is there are some great things about LA and California, which I'd love to get into, because largely those remain true.
Yeah.
And then have made it a really good place to invest for a long time. But I will say that as those things started to be less true, as it became harder to invest here, many of my peers chose to go to secondary markets, Denver, Phoenix, whatever. And they were right to do so. And I responded to things getting more difficult here by becoming more and more creative about how to do deals. Mm-hmm. And it was cool. Like, we learned a lot, and I'm proud of the fact that we did really well. We genuinely produced really good results in a market that was like basically impossible for almost everyone else. And so that was cool. It was like a lot of sweat and a lot of creativity and all that stuff. But in retrospect, the smarter thing to do would have just been to like go buy a big building in Denver with the biggest mortgage that I possibly could have in like 2015, and just, you know what I mean?
Right.
And so I think the strategy was definitely suboptimal.
Yeah. And is that because the Denver market grew a little bit faster than LA?
Yeah. So my underwriting has always ignored future rent growth. Mm-hmm. In other words, what I've tried to do is to say, look, what do I know today to be true? And what I know today to be true is, like, what is it going to cost me to buy this building? What is it going to cost me to renovate it? And what rents could I get today if I had those units ready to go? And what would my operating expenses be? Yeah. And that allows me to calculate an unlevered yield on cost. And so what I've done is looked for buildings where I could generate like really high unlevered yield on costs. Okay, but what that ignores is rent growth, right? And and that's and the reason is, like, just temperamentally, I have always been pretty unwilling to bet investor money on something that I didn't know to be true. It's like, what do you mean rents are going to grow 3% a year? Mm-hmm. I don't know.
Yeah.
Like, how does anyone know that?
Right.
And in fact, in LA, like, we've subsequently seen rents fall by 15, 20% a few times, like, mm-hmm. In both of the GFC and then during COVID. So it's like, so I have always been pretty loath to just sort of like, bet on the come and hope that things are going to work out. Yep. But what ended up happening is that rent growth in those secondary markets, Denver, et cetera, vastly outpaced rent growth in LA. And so you could do really well just by, like, basically throwing a dartboard at a map of Denver or Phoenix or wherever and buying a big thing and using a big big loan. Yeah. And I don't mean to be disparaging about people who did that. I mean, like, they made more money than me. So it just conceptually, I'm not a momentum investor, and that's what that is.
Yeah, that makes sense to me. Do you see yourself expanding outside of LA?
Yeah, that's a really good question. So the tension is this. I don't love business travel. I just find it to be like a very disruptive to my life and my family and all that stuff.
The people who do it and are road warriors, like, I'm impressed by them. I just brought this up to my wife yesterday. I was like, I just flew to New York and that was harder than I would like it to be,
Yeah, and I'm a creature of habit. Like, I take my kids to school every day. Yeah. I have breakfast at the same place every day. Like, that's important for me to, like, in terms of maintaining my, just like everything about my life. Yeah. So what I've done is we are actively looking at other types of assets in Southern California, which we could buy and renovate without needing to do a lot of business travel. And then separately, with partners, I started a business called Reseed, where we provide seed capital and then deal capital to emerging multifamily operators in other markets.
Yeah.
So effectively, we're sort of bringing them on to do the scut work of like finding and operating deals in these other markets. And I'm still doing a fair amount of traveling for that, but it's like travel to the deal once, decide if I think we should buy it or not, and then once we do it, it's for the most part it's on the operator to do what needs to be done in that market.
And then the deal there for Reseed is, let's say, young operator or someone who's like early in their career, maybe have bought one building or none at all, and I'm looking for a financial partner and some like resources to make sure I don't step on any landmines. Maybe similar to like your hedge fund buddy was the capital side, and maybe your parents were like the real estate side for you earlier in your career. Is that kind of right?
Well, that was the thesis when we started. In real life, we have ended up getting operators who are considerably more experienced than that. In this most recent cohort, all of them have extensive experience. All but one were in business themselves and had done a bunch of deals. One group had not been in business for themselves, but they were senior at another shop, at a development shop that had done a lot of stuff. So they have a lot of experience doing large, complicated stuff. So the experience level of the operators is higher than we expected, but in other respects, what you're saying is roughly true. So we provide a little bit of capital that goes into their operating company to help them live while they're chasing deals. And then in exchange, we get a small ownership stake effectively in their operating company. And crucially, we get the right but not the obligation to provide up to 100% of the capital for their deals.
Got it.
And then their job is to go out and search for stuff. They can kind of do whatever kinds of, like if they want to go flip a shopping center, they can. They have to pay us our share because we have our ownership in their operating platform. But we're probably not going to capitalize that deal. But if
you're focused on multifamily,
yeah, we want to own multifamily. Although watch this space because we're looking at expanding at least into one other asset class right now. But if they find an apartment building that is appropriate for a long-term hold, and that's what we're looking for, stuff that you'd want to own and have just, you renovate it or whatever you need to do to get it stabilized, and then it hopefully produces like a above market quality yield that's tax advantage over time. As they find those deals, we'll put up the money for them.
And are you guys following the adaptive model, trying to buy all equity or mostly equity for those, or is this more of a traditional?
No, everything we've done has been, I want to make sure I'm not, everything we've done so far has been all cash. We're not averse to using leverage, but right now in multifamily, and this is why I have not been particularly active over the last couple of years, the pricing, I guess as I said before, the pricing has not adjusted to today's higher rates. So in most cases, you're going in at negative leverage. And so in a scenario where you're going to, why would you do that?
Yeah.
It's just better from the capital partners that we have at Reseed. These are people who have excess capital, right? They want to put out, right? Like they're not, like if we go to them, we're like, hey, we want to borrow at 6.5 or 7 or something. They're like, I would rather just have my money out earning that. So let's just buy it all cash.
Yeah, that makes sense. I want to talk a little bit more about negative leverage in a second as a concept. How many deals or like total deal size have you guys done in Reseed in last year?
Yeah, we
just for a sense of scale.
Yeah, we bought. I think we put out $25 million into. I want to say 4 deals last year.
Nice.
And that was really all in the second half of the year. So we did nothing.
Because you guys just spun it up maybe a year and a half ago.
I think we might be closing it on 2 years.
Yeah.
Maybe something somewhere between a year and a half and 2 years. And for the first year-ish, we basically didn't do any deals. And then we got really active in the second half of last year, and that's continuing. We have several things in the pipeline right now.
And it's actually interesting. So for a new concept like reseed, you never know how things are going to go. What we have found is there was considerable investor appetite, so we raised a lot of money. I think we've raised like 200-ish million in various buckets, and it's actually the deal flow that has been lacking. Like in our business, you're always trying to balance like capital and deals. So for a while, it was pretty frustrating because we crushed it on the capital raising, but where are the deals? And that's sort of beginning the second half of last year. That's kind of become unstuck, and we're starting to see stuff.
Got it. And I've seen you post a little bit about the concept of negative leverage, where you're talking about stabilized cap rates, and you're kind of asking what are people seeing in these types of deals? Can you talk about those two concepts? Yeah,
I mean, well, there's a couple of different things to say. Like, one is conceptually, if you're going to take equity risk, right? Like, not to kind of like go back to like first principles or whatever, or like, finance 101, but with equity, obviously you're bearing more downside risk in exchange for getting upside. And with debt, in theory at least, you have very little downside risk, but your upside is capped, right? And so if you are, the market right now for apartment buildings roughly is like that debt, for senior debt, first position debt, is like 6.5%. Okay. So if you're, that's like first position, senior debt, you have very little downside, things go wrong, you take the building, and in theory there's an equity cushion there and you're in good shape. You don't lose money. Why should equity, where you're taking all this downside risk, be willing to tolerate a lower than 6.5% yield to do these deals? Right. And that's probably really the problem, is like you're borrowing at 6.5 to buy an unlevered 5.5 or something like that. And then as a result, the yield to the equity is going to be lower than 6.5. So what the reason you could be doing that, like a reasonable reason.
And just to clarify, in an ideal world, you are borrowing at 6.5%, but you're getting at least a 7.5% yield or something.
seven yield. So if you buy an unlevered
so then there's
7,
like a positive.
Yeah, then you're getting a positive. Exactly. If you buy a 7 with 6.5 money, you're going to do better than a 7 for the equity.
Yeah.
And if you buy if you buy a 6 with 6.5, you're going to do worse than 6.
Right. And what that I guess means simply, and correct me if I'm wrong, is like if I bought a building that was $1 million and it is generating $70,000 of net income per year, and my loan is $65,000, then I have like a $5,000 cushion. Is that correct?
Yeah, that's not quite. I would want to think about the numbers that you just said a little bit more, but it's like the question is just, is the return to the equity, like there's a comparison between the cap rate, the unlevered yield, like assuming you bought the building all cash, you buy that $1 million with a building with all cash, and you're going to get $70,000, right? Mm-hmm. If you borrow on it and the rate is a lot higher than that 7, then whatever equity you put in is going to get less than a 7.
Yeah.
Right. Because you have to disproportionately pay the debt.
Yeah.
And it works the other way too, where if the yield, the interest on the debt is lower, then there's going to be more dollars available. That's positive leverage, and that's kind of ideally what you'd like. Yeah. So right now, broadly speaking, in multifamily, we're in a negative leverage world. And so why would you do that? Well, you might believe that that interest rates are going to come down, okay, mm-hmm. and then you've just bought an asset in a high interest rate world, and like interest rates come down. In theory, the assets should go up.
It goes from 8 to 6, and then you refinance and
or you sell to someone else or whatever. Like in general, cash flowing assets ought to appreciate if interest rates come down. Mm-hmm. But like. My view on that has always been that, if I wanted to make interest rate bets, there are easier ways to do that than buying like mm-hmm. messy apartment buildings. Yeah. Like you could just go trade bonds, right? So I don't really. I think that I think it's probably a mistake
to buy an apartment building as a bet on rates coming down. And I think a lot of people over the last couple of years have been hurt by that. Like there was really a sense when rates first spiked, okay, like let's get in there, buy stuff now and then rates will come down. And this is what the brokers were all pitching.
Of course.
And it turned out to be horseshit. And anyone for whom that was like the primary driver has now discovered that rates can actually stay elevated.
Yeah.
So that's one. The other reason you might buy a negative leverage deal is you might expect that rents and therefore net operating income will rise. Okay. And that can happen one of two ways. It could be like natural market, rents just rising, or it can be sort of forced appreciation where you go do something to the building to push the rents up. In reseed, what we are doing is more of the latter, where we're looking to push the rents up by renovating. But when I complain, this is a very long way to get back to your original question, but I complained on X about people who are buying like 5%, like 5 caps, so 5% unlevered yield in a 6.5%, with 6.5% money. And I'm like, why are these guys doing it? And the reason I find it particularly stupid is because these are rent stabilized buildings. Okay. And because they're rent stabilized, it means that the rents can only grow by a certain amount, absent you going and like vacating the tenants by doing buyouts. The rents can't grow quickly enough to make this good.
Right.
You know what I mean? Like it's like you're doing this thing where ordinarily, you're thinking about an investment. You're like, what's the downside? What's the upside? And like, try to balance the two. And obviously you're looking for situations where the downside is relatively limited and the upside is large. And so you do those. And this is like, I'm just looking at it and going like,
You're
there's no conceptually there is no up you're not going to grow out of this thing fast enough to make it make sense
unless Jerome Powell's called you and you have some kind of direct line
if you have some
rates.
exactly
something that nobody knows
and I know the numbers better than most, so when with those deals I can look at them and I can be like, okay, well let's consider that maybe what they're trying to do is vacate the tenants and renovate the units and push the rents. And I'm like, nope, know the numbers on that too. And that still doesn't work either. You know what I mean? So you kind of like, if you've done enough of these things, you can look at it and just be like, no, this is just a loser.
Right.
Like from every angle, it's a loser. Except the speculative one where maybe rates come down. But like, again, you want to make that bet.
That's also a
yourself
loser
up.
bet.
I mean, who knows? Maybe not. Maybe rates fall tomorrow. I mean, I don't know. But it strikes me that is a stupid way to proceed. And I mean, anecdotally, in talking to brokers who are doing deals right now, and deal volume is, for the reasons that I've just been discussing, deal volume is really down.
Okay.
But people are still buying stuff. But it's interesting. It's like really bifurcated. So above 10 million, nothing. Below 10 million, still some action. Why? Well, above 10 million, it's going to be like your institutional capital, and those guys are just like, this is
doesn't work in a
obviously
spreadsheet.
stupid. Yeah, this is not, and there's also the regulatory issues in Los Angeles, which they're just like, there are easier ways to make money than this. Okay?
Yeah.
On the smaller deals, it's like largely mom and pop buyers who are often represented by residential agents who are not, like, either don't understand the predicament that they are putting their clients into, or don't care.
Yeah.
Right. And so,
well, they're incentivized.
They're incentivized. Right. Exactly. Yeah. Oh, real estate always goes up in Los Angeles. You can think of a million different, rates are going to come down. Yeah. Oh, this area is getting better. Oh, there's a million things that you can say to talk someone who, is a dentist or whatever. Like, and people make fun of dentists or other, let's call it amateur real estate investors. And it's like, no, those people are very successful in their own right, in their own fields. Like, there's a reason that dentist has $3 million to put in an apartment building. That's amazing. This is a very successful dentist. Yeah. But that person just may not be familiar with thinking about the things that I'm talking about, and therefore is kind of like vulnerable to, again, either an unscrupulous agent or an idiotic one, but it kind of like doesn't matter which they maybe come from like an immigrant family, or somebody told them that California real estate is always good, like my family, and they didn't want to think too much beyond that, or they didn't really know how. And I want to say that there are good deals being done right now. From my perspective,
the problem is not that the deals are bad. There's two different things going on. There's two different types of buyers. Okay. If you're deploying your own capital, you buying that building, okay, there are good deals to be done right now. You know, are they good relative to your options in the stock market? Don't know. But like, I can look at them and be like, you know what, if you're paying whatever, let's say call it $200,000 a door for some rent stabilized apartment building, and the yield is sufficient. Like, it's not great, but it's kind of okay. And you know, if you sit there long enough, you're probably going to do all right. Okay. So that's one. So for a mom and pop investor, like that's maybe not crazy. If you want to use other people's money, which is what the business that I'm in is fundamentally using other people's money, right? And so if you're going to use other people's money to justify your existence, like what using other people's money means is that you're going to get a fee, right? And ownership in the deal in exchange for your services in identifying and executing the deal, right? That's the trade, okay? And so implicitly what that means is that if you're going to be a deal sponsor, you need to be able to identify and execute deals that can generate returns sufficiently large that your investors would have been better off doing it with you than they would have been just buying their own building. Yep. Okay. And that's what's not working right now. There's just, I have not been able to find, and we look a lot, in the apartment business, I have not been able, in the apartment, the kind of like across the broad set of opportunities that are in like the Los Angeles area, I have not yet seen anything where I felt like, in a while, where I felt like the returns that I could conservatively project were sufficiently large to justify my involvement.
Makes sense. I get that difference now. I want to talk a little bit about specific deals that you've done in the past and what those looked like kind of going in.
Yep.
With all the details and the price, and then what those look like coming out.
Sure.
And, you know, maybe some of these were a while ago, so you might not remember specific details. But you did mention one of them was, I think, here in East Hollywood, which is not too far, I guess, from where we are.
Yeah. So, and let me just say, like, this is going to sound crazy, but we've quarterbacked the renovation of more than 110 apartment buildings in Los Angeles since 2008. So I really can't remember all the numbers on all of them. Yeah. And I chose in preparing for this conversation, I chose deals that were both a little longer ago, and also where there were not political sensitivities. Let's put it that way. Okay. So we're talking about a very specific set of deals that we can talk about publicly. But yeah, so the deal that you're referencing, the first one we talked about is on Burns in East Hollywood. That's an area we know really well, and we own a lot of stuff there. And that deal was came to my attention on the MLS. So this is important to understand. So many people have the idea that a deal is only interesting as if you see it off market. Like if some broker, you source it with a postcard to some owner or broker said, got it off market. The truth is that most of the deals that we've ever bought were on market, and we were able to generate really good returns because we looked at them differently than other people did. So this one was a couple of things going on. One is the broker was honestly just a moron. Like I don't want to go into too much in the way of specifics because I suspect he's not in the business anymore because he was not good at his job. Yeah. He dramatically underpriced the asset. So this was a 3-unit building that was going to be delivered vacant. So none of the, despite the fact that it was rent stabilized, there were not going to be any tenants in it at closing. And he just priced it off the top. I mean, I can't remember exactly the numbers, but he probably priced like a couple $100,000 below what it should have been right off the top, right immediately. It's just like, this is obviously stupid. Yeah. And so right away we see it come on and we're like, this is dumb. Like immediately the alarm bells go off. This is like, yeah. And we're like, call them up immediately. We're like, we'll do all cash right now. You can represent buyer and seller, so you're going to double your commission, and we'll do it right now. We'll close in 10 days. Okay. And to him, because he's not someone who is in the market very much, that sounded great. Yeah. Like, his seller wants this price. He got him this price, all cash. He gets to double in and double his commission. Boom. Okay. So he gets the seller to sign it up. Of course, over the next couple of days, right,
offers are pouring in because we're not the only people who
Right.
noticed this.
Yeah.
I mean, he probably got 30 offers, and probably all of them were all cash.
Right.
I mean, everyone with a brain who was looking at that market was like, this is stupidly priced.
Yeah.
Of course, so there's a law that where brokers are required to present their clients with bona fide offers that come in. So he's sitting there and he's tied up. He's allowed us to tie the deal up at his initial idiotic price.
Right.
And meanwhile, he's got all these offers pouring in at higher prices than what we're in contract on. And so clearly he looks like an idiot in front of his clients.
Yeah.
So inspection day rolls around. And this is the point at which he's supposed to allow us into the building and to do our inspections, which is part of the contract. And he's like, I'm not letting you in. And I'm just like, because he wanted to chase us out of the deal, so that he could then take one of these. I'm not letting you in.
Yeah.
And it was embarrassing to me because I had already brought to the inspection this family with whom we've partnered on a lot of deals, and with the idea that they were going to provide the capital for this one too. So I bring them to. I'm like, this is a great deal. They agree. They look at the numbers. Like, it's very obvious this is a great deal. Right. So we show up, and this lunatic is like, I'm not letting you in.
Great.
And so I have to go to these people, and I'm like, listen, I'm so sorry for dragging you out to the east side, whatever, but, hold that thought, basically. Yeah. And then we went to a litigator and had him write obviously a really threatening letter, and totally justifiably. I mean, this was completely outrageous behavior. It was a violation of the contract. It was a violation of the professional ethic. I mean, it was just, you name it, it was bad. And so he relented and eventually led us toward the deal. And interestingly, my idea when we had got it into contract was that it's on a very large lot, and the zoning was favorable for ripping what was there down and building a larger building. And so that was what our plan had been when we got it in contract. But when we took this family to see it, the wife actually, she's brilliant. She in a former life she was in private equity. Like she is really, really sharp. I wish she would work with me, to be honest. She was like, I don't mean to be. Smart LPs are like this. They're like they're very delicate about kind of like contradicting the GP because they think that you're going to be arrogant, and so they want to be, and they don't want to tell you how to do your business. Yeah. But I'm not arrogant at all about this stuff. Like, I don't care where the idea came from. It's how idiotic. If you have smart LPs and they're like, you should by all means, you should listen to them.
Yeah.
And in this case, she was just like, look, I don't mean to tell you your business, but like, it seems to me that if you just took the existing structure and renovated it to add units in the existing footprint, which the zoning would also allow, the yield would be probably higher than what you're forecasting to scrape it and build a new building. And you would be avoiding all of the nonsense involved in the permitting process in LA. And I thought about it for about 5 seconds and I was like, you are absolutely correct. Yeah. Thank you.
Yeah. Wow.
Yeah.
That's a good LP.
Great LP, provided all the capital, and
here's how you do it.
I mean, I had the deal, so, so we bought it, and here's a mistake that I made, and I repeated this mistake a lot. So the real estate private equity model where you're using other people's money, one way to think about it is you want to do as many deals as you can, as the GP. You want to do as many deals as you can with as little of your own money in the deals as possible. Because that means you can do more deals and you collect more fees and you have more promotes and so that's good. So you're more highly levered because you're the highest leverage point in the capital stack. But the mistake here was this deal was a no-brainer. Like, we were buying it too cheaply. There was no risk that we had to relocate tenants. We knew that we were going to be able to get the plans approved because of the zoning and the parking that we had. And yet I still minimized my partner's capital contribution to the deal. And even though I'm looking at the numbers, I'm like, I know that like 18 months from now, we're going to be able to refinance out all the money. Yeah. Like we will, for sure, we own a bunch of stuff in the neighborhood. We know exactly what the rents are. We're doing a bunch of other construction. We know exactly what the construction, this was as close to a no-brainer deal as you're going to find in our business. And I stupidly was like, well, I think we put 10 grand into the deal or something like that. And I could have done as much as I wanted. It was my deal. And I mean, comically at the time, the LP was like totally fine with us putting in nothing, right? And I was like congratulating myself for being this, for like having such good investor relationships that they didn't need me to put any co-invest in and whatever. And it's like, no, you fucking moron. The reason that he doesn't want you to put money in is because it's such a good deal. He would like to maximize the amount of money that he is putting in. And it turned out, like, you know, I think less than 18 months later, we finished the construction. We rented the units out for more than we had initially thought we were going to, and the debt market had cooperated, and we refinanced out 110% of the capital employed, which was enough to not only obviously return all the capital, but also to clear the accrued preferred return. So like 18 months from the day we bought it until that refinance, we got our promote, which I think on that deal was 35%. So effectively in 18 months, we were like, all the money's returned, all the pref's returned, and we're 35%.
Every deal, dollar after that is 35% basically.
Yeah, but the real way to think about it is just in a permanent hold model, it's just effectively we're like 35% owners of that deal. And so we've forever afterwards, we've received 35% of the free cash flow from that building. So that's like, in one sense, that's like I mean, things can't go better than that in our business. That's it, right?
Yeah.
At least in a long-term hold business. But if instead I had maximized my own capital contribution, I still would have had the same effect. I would have gotten it all back in 18 months, plus a kicker, plus the pref. Yeah. And I would have owned even more of the deal. 50%. Yeah, whatever. Yeah. So that was in retrospect, it was an amazing deal, amazing deal, but a mistake, I think, in retrospect to under contribute.
Do you remember directionally what the numbers were? Like even if you're within range of like buying, remodel, and then, and I guess do you still own it or did you guys sell it? You still own it?
I would struggle to get to the exact, it was under $2 million in total capital. I would struggle to give you, and then to be able to refinance out as much as we did, it means that we were, given the interest rates at the time, I think we would have been roughly like in a 7.5% unlevered yield. So, like in other words, we constructed for ourselves a 7.5 cap or something like that in a world where you could borrow at 5. Like that difference doesn't sound large, but that's a very big difference in our business. You could drive a truck through that premium. Yeah.
Okay. You taught me a little while ago about this concept of crystallization. You'd posted about it on X, and I think what I remember, you said that you would wish that you had learned about the concept earlier and perhaps started earlier. This is particularly specific to long-term hold investors, is my understanding. So can you walk us through this concept, because it's something that I've actually adopted in some of our projects?
Yeah, and I learned about this from another GP who is an apartment developer. And it was already pretty late. I think I probably learned about it maybe it was 5 years ago. Yeah. And I remember sitting there looking at him and being like, I can't believe I didn't know about this 10 years ago.
Yeah. I mean, God bless X and you posting on it, because like I'm learning on it before my first deal. You know, like it's just, it makes such a big difference.
So the concept is as follows. The ordinary way that people do real estate private equity type deals is they buy a building, they renovate it, they use as much debt as they can, and they sell it as quickly as they can, because those steps are IRR maximizing. And the economic arrangements between the deal sponsor and the passive investors incent the sponsor to maximize IRR. So that's what he does. Okay. The problem is if you as a sponsor or the passive investors or both want to instead hold the building long term, it's like, what do you do? Because from the GP's perspective, it's like, look, I know what I want to do. I want to sell this thing because like I want to crystallize my pro. I want to sell it and I get whatever I get, and we run the waterfall, and now I got my cash, and great. Now I'm rich. So what do you do? So the concept of crystallization is roughly as follows. You pre-negotiate on the way into doing the deal. The GP and the LPs pre-negotiate a clause that basically says that at a given point in time, and this can either be, it's some combination of a specific time period, like
3 years, or it's at the conclusion of the business plan. So like we renovated the building, we leased it back up. Okay. At that point in time, what we are going to do is we're going to value the building. And it can be valued in a number of ways. We can just have a negotiation and value it. We could hire appraisers. We could get a bunch of broker opinions of value. However you want to do it, there's mechanisms. We're going to value it. We are going to pretend that we sold the building at that value. Okay. And we are going to run the waterfall as if we had sold it. Yeah. So we're going to pay down accrued, usually the order of distributions is first to pay off accrued pref, then to return capital, and then subject to the GP-LP split, 70-30 or 80-20, whatever it is. So you, at this pre-agreed moment in time, you value the building, you pretend you sold it for that price, you run the waterfall. Okay. And the output of running the waterfall is the amount of money that each side would receive had we sold it at that price. Okay. But instead of selling it, you're holding it. And so what you do is you just say, okay, look, let's take the total amount of cash and let's figure out what the pro rata ownership percentages are between LP and GP. And then let's just from that point forward, there's no preferred return anymore. And it's as if the sponsor of the GP was just an owner of whatever portion of the total cash he would have received from that exercise of running the waterfall.
So for just using whole numbers and not running the waterfall, you bought a property for $10 million, you post stabilization, it's worth $15 million. Let's just say when you ran the waterfall, the GP was $5 million, the LP was $10 million, or maybe 4 and 1 or something like that.
Yeah, it's not going to work. It's never going to work in the 10 and 5 because the LPs have to get something, right? So it's going to in your scenario, it's more likely going to be like, in a good outcome,
3,
maybe
12.
it's 2 to the GP and 13 to the LPs or whatever. And so you would just go, okay.
You get your relative percentage.
Yeah, you just divide the, let's say it's 2, exactly.
Yeah.
Let's say it's 2 million to the GP and 13 million to the LPs. The GP would end up owning 2 divided by 15 and the LPs would end up owning 13 divided by 15.
Got it.
And that from that point on, it's as if they contributed the actual capital. The GP still runs the deal as if he would, he's still overseeing the management company and doing whatever else he's going to do. But the ownership effectively is according to those new percentages that we just talked about, and the result of that is that at that point the GP is now just like in one sense is just like a passive owner, just like everyone else, and is going to act like, hopefully, like the way that the other passive owners would want him to ask. Yep. He'll refinance when it makes sense to refinance. He'll watch the property manager, et cetera. And the benefit of doing this is that it allows so there's a trade-off from the GP's perspective, though. And that is, if the deal goes well, okay, and you don't trigger the crystallization clause, then over a long enough period of time, the GP will end up owning a percentage of the deal equal to whatever the carry number was. So like in the example that I told you, that perfect deal that we did in East Hollywood, it was a 65-35 split, 65 to the LPs and 35 to us after return of all capital and preferred return. Because that deal went incredibly well, and that one happened to go incredibly well quickly, we now own 35%.
Yeah.
Okay. In most scenarios, when you run that promote crystallization, what's going to end up happening is the GP will end up owning considerably less than whatever the carry percentage was. Mm-hmm. So instead of even though notionally in the math we could go through why this is, but just for the sake of this conversation, just assume this is true. The result's going to be that as a GP, you're trading the chance to own 35% someday for the certainty that you're going to own 15% today and going forward.
Got it.
And so we did not have promote crystallizations in our deals. And so as a result, what I've done effectively is I've forwent the opportunity to do that promote crystallization and be certain that I'm going to own 12 or 13 or 15% or whatever, in hopes of eventually owning 30 or 35. And so that worked out really well in some instances. In other instances where we were not in the promote into the carry prior to rates coming up, the result is that day when I end up owning 35% got pushed way into the future. Does that make sense?
Yeah.
So in retrospect, you're damn right. I wish I had promote crystallization clauses because I would have crystallized and then rates would have come up and whatever, but I would have been the 15% owner or whatever it was. And that would have been great.
And you can use some of that money now. For
exactly.
Activities.
So anyway, so that's the trade-off with these promote crystallizations. Yeah. I think as the GP, what you would ideally like is the option to crystallize, but not the requirement.
And I thought that's how it's baked in. I usually thought that's how it's written in, is like use the GP, have the option, but you don't have to do it.
It's whatever you can negotiate with your LPs, right? I mean, like so. To give the GP the option that's a very, very powerful option, obviously, because the GP is going to be the one who's best positioned to guess at what the future is going to be like. And so obviously that option is very valuable. I could imagine a deal where it was like, no, like it's not an option. It's just, we're marking it 3 years in and that's it.
Yeah.
And maybe it worked out well or maybe it didn't. So, I mean, all these things are subject to negotiation between GPs and LPs. I
want to talk about the second deal that you shared with me. It was a deal that was an Echo Park. You know what I'm talking about?
I mean, we called it Echo Park. It's funny. It's right here in my office now. This one is a little south.
You call it Echo Park. It's actually like in Riverside or something.
No, it's I don't even know how you would describe that anymore. Maybe it's a historic Filipino town, but it's a little east of there actually. Anyway, it's south of Echo Park, like south of the 101. And that one was another one that was on the MLS, delivered vacant, a duplex, so 2 units, side by side, single story on a lot that fronted on Alvarado, but had crucially an alley behind it. And the zoning allowed for you to build more units on it. And so the business plan here was effectively to add another story to the existing building and take it from
two duplexes?
To go from 2 side-by-side units on the ground floor to a 4-unit building with 2 on the ground floor and 2 on the top floor. Now, that's conceptually what it was. In real life, as I later discovered, when you can't just like add a story on top of a building. That's a nonsense. That's like the kind of thing that an idiot thinks. A 2-story building has a much larger foundation than a 1-story building. Like it also has like the structural, the load bearing parts of the walls are much heavier.
Yeah.
Like it's just like
this is all news to me. So
it was. Yeah. So effectively, this became one of these like legendary LA renovations where only 2 2x4s remained of the original structure. Like it was actually really funny. It was like the whole thing had been demoed, except 2 2x4s with like a little chicken wire between them and the remains of the stucco, but just from the panel that was this wide of stucco, and the rest of the building was gone.
And is that for like some like keeping grandfathering in?
Yes,
or something? I've
because
seen this before.
if you do that, your architect can get the plans through as a substantial renovation instead of a ground up project. So you avoid triggering a whole bunch of requirements that are standard for a new construction project, but which are not standard for a rehab, and it was like preposterous. But anyway, so we did, and again, there's another one where so your idea on paper, add the story. In real life, it's not that. Another problem. When we were looking at the deal, crucial to making it work was that we could fit 4 tandem parking spaces in the back off that alley. So you could as a tenant you'd drive through the alley and then pull into the parking. But when we realized, we bought the property and then we had inspected it, blah, 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 we went and bought it. We realized when we actually started to do it that the neighbor on the other side of the alley, this was a very unused alley. Okay, I mean, I don't even think it was paved. Like it was one of these like vestigial kind of alleys in the alley. The neighbor had taken the opportunity to basically illegally expand his garage by, I think, like 3 feet into the alley.
And this is like part of your alley that you kind of like, or it's
the alley is separating the back of my property from the back of his property, but no one's been driving through there for years. So what does he care? Like, he's just like, look, no one's driving there. It's public land, but he effectively just like expanded his garage. And our problem was, we are like, look, when we're going to build this building, and then the inspector is going to come to sign off on it. And he's going to look at the parking and he's going to be like, there's not enough backup room for people in these tandem parking spaces to back up into the alley and drive out because the garage is there. So we're sitting there and we're like, okay, like we bought this building already. We've got the permits, but we can't start building it because we can't. If we're gonna, the nightmare is you build the thing and then like the guy won't give you the permits so anyway. As a result, the solution was we start banging on this guy's door, and we had to go to him and be like, "Listen, man, like this is gonna sound crazy, but we need to chop 3 feet off the back of your garage."
I'm sure he was really happy to see you guys.
Well, he was not thrilled, but so what we did is like. And I can't remember if we made the threat implicit or if we made it explicit, but it was basically like, look, like the inspector is going to be there and he's going to notice that your garage is 3 feet into the alley.
Yeah.
So probably he's going to red tag your garage and make you rip it down. Yeah. So it's like, so instead, why don't you let our contractor slim down your garage by the relevant 3 feet. Yeah, we'll pay for it. Yeah. And to his credit, he agreed. Obviously, it's a pretty sweet offer. So before we started the construction, we had our GC just like went in there and like over the course of I think like a day or two, basically moved that thing, got rid of that illegal extension to the guy's garage to allow us to have the parking and build the building.
Man, real estate underwriting's terrifying. I guess all business underwriting's kind of scary, but like, you're buying this building, you want to add some stories, you need a certain amount of parking, you got to get it through all this like permitting process. There's like a lot of things that kind of have to come together to realize the outcome.
Yeah, and you know, anyone who follows me on social media knows that I'm constantly complaining and whining about zoning and building codes. And part of that is the complexity involved introduces risk. So like the more complicated the code is, the harder it is for a developer working with his or her architect to look at a given property and know what he can build. And yet fundamentally, that's what you have to be able to do before you buy the property, right? And in LA, we don't, for the most part, have like long escrows. Like if you're building in the suburbs, you could convince an owner to like let you have a 2-year long escrow period where you get in a big fight with the city and figure out exactly what you can build, and then you commit to buy the property. Yeah. It doesn't work like that for small pieces of property in LA. Like you basically have to buy it and then hope that you can build what you thought you were going to be able to build. Yeah. And the problem is obviously that the more complicated, the more layers of different regulation from different authorities and et cetera exist, the harder it is to have certainty about what you're going to build, and therefore the higher the expected yield needs to be to get you to move forward. So it's implicit, and which means that fewer projects get built. So fundamentally, it's the complexity itself that is restraining the supply.
Yeah. One of the ones you've posted about in the past that drives me nuts as a just user of the city is the parking requirements of like for businesses, for apartment buildings. It's kind of like you have all of this land that's dedicated to parking, and therefore every building has to be so far away from each other.
Yeah,
that's me as a user.
Yeah, it's pretty terrible. I mean, that is, and this is hats off to the YIMBY movement. That has, a lot of those requirements have been removed over the last couple of years, which is as it should be. I mean, basically, think of the arrogance, right? For the city to tell a developer who's going to risk millions and millions and millions of his own and investor dollars to build some new thing. Think of the arrogance required to tell that person that you know better how much parking he needs on his project than he does. Like he's like talk about skin in the game, right? Like he's going
to figure out the optimal amount of parking for his customers.
And you'd be surprised in both directions what makes sense. Right. And some people build stuff that's overparked because they understand who they're dealing with, and some people are willing to take the trade where they're like, look, we're going to build stuff that's like underparked relative to what the code would ordinarily require, and it turns out our tenants tenants don't care.
Yeah. Yeah, we're working on a project where there's like a small cafe, and I assume just like it was in LA, you need X amount of, you can only have X amount of seats if you have X amount of parking spots, right? Because they assume that each car has two people. And for us, it's like, well, people bike in this town, people walk in this town. There's so much parking on the street. Like, why take up this kind of valuable, useful space and limit the size of this little cute cafe in order for people to be able to just like park on this property,
Yeah, I think in real life, look, you could construct, the steelman argument is like, look, you're imposing this externality on everyone else. Like, yeah, your business is going to be fine, but what about all the other people who are going to have a harder time parking in the neighborhood, blah, blah, blah. Yeah. But then you're like, well, why should the last person who comes to the party have to do all the dishes for everyone else?
Right.
You know what I mean? Like, it's like the businesses that are there are getting to take advantage of the fact that there's street parking, right? And so to say that, it's the new entrant who can't use the street parking is effectively to create this moat for the existing businesses, right? And that's really, I think, to a large extent, what's going on with all this stuff. It's really just in different flavors of protecting incumbent property owners and business owners.
I just dream of European cities in some part of LA. Let me just get a neighborhood with like 4-story buildings, no parking requirements.
Yeah, no side setbacks. Yeah,
no
I think
setbacks.
I see
you post about
yeah,
that too.
one of the things that really frustrates me about LA is, and we've made a lot of progress in terms of removing parking, et cetera, making things a little bit more developer friendly, but fundamentally what we're doing is because we still have side setbacks and we still have, for the most part, front setbacks and rear setbacks, and which the effect of that is to make it's impossible to build the kind of walkable neighborhood that you're dreaming of, where you have buildings that are right next to each other. And so what you get instead, I call it like fake density. Like, you get all of the downsides of density, but without the walkability, because there's still like a 5 foot and then 5 foot setback and then another 5 foot setback. So it's 10 feet between buildings. It's just awful.
Yeah.
And so you're like, in my opinion, you would be much better off designating certain parts of the city that are well served by transit and really letting people go for it, like build Manhattan or whatever. And I think you would then, the people who you would see that there's a ton of demand for people who love, there are people who love that, and they're getting the benefit of all that walkability and all kinds of interesting retail and all the good stuff. And then you could keep the single family zoning that people also like about LA, because you don't need to do this kind of like fake density across the whole city.
Yeah, I would live in that neighborhood. I spend 5 days a week on my bicycle or on foot. I don't drive around, so that's an optimal situation for me personally. I want to ask you one last question. You also write quite a bit about this concept of being the founder of your family, and it's something that really resonates with me. My family are immigrants. I would say we restarted when we came to this country, and I'd love to hear a little bit about how you think about this concept.
Yeah, well, first of all, I want to say that I am not the founder of my family. I think that in every family, obviously every family goes back to the beginning of life on Earth, right? So like, there's multiple founders along the way. But I guess if you take a given family and it is lacking in resources, both like, financial and tangible, but also possibly like cultural or like in terms of behavior or human software or whatever, it falls to someone, and that someone, if whoever is most recently born into that family is going to change things, fundamentally there needs to be a break with what was going on before. Like, something needs to change, right? Like, or you're going to continue the pattern that you're born into and then pass it on to your kids. So someone fundamentally has to put their foot down or put their hand up, or whatever metaphor you want to use, and say like, I am going to be different. Like, this hereafter, things will be different. And frequently that requires an enormous amount of discomfort, right? Whether it's moving to a new country, like my great-grandfather Morris did, whether it's like scrimping and saving to put together the initial capital to start a business or buy a first building or whatever. It requires almost like superhuman levels of toughness and resourcefulness. And frequently when that generation doesn't even necessarily get all of the benefit of that hard work and suffering that they've gone through, like,
they bear the pain, but the benefits exist for their children and grandchildren thereafter. And I think that it is important that families venerate the people who did that. It's an enormously self-sacrificial move to say, I am not going to sit around playing video games. I'm not going to, or drink the money away or whatever. Instead, I'm going to live a life where I intentionally constrain my own choices in order to create a lot of choice and optionality and good things for the people who come after me. Yeah. So that's the concept of the founder.
Yeah.
And I think that I think that families need to, like, if you are from a family where that has not happened and you would like to change, you need to think of yourself as the founder.
Yeah.
Okay. And for families that have been fortunate enough to have had a founder, like my family has, in the not too distant past, and where the family continues to benefit from the sacrifices that the founder made, the trick to making sure that the kids, that subsequent generations do not become fuck-ups, is to tell the story of the founder.
Yeah.
So that the kids understand what it was like before the founder, and how much they've benefited from the sacrifices that the founder made, in hopes that they don't piss away what they have been gifted because of what the founder did.
Yeah. I think that's so wonderful. I think once you get a few generations away from it, and you're just used to your life, it's so hard to even imagine how difficult whatever this person came from.
Yeah, and families unfortunately lose these stories.
Yeah.
And so in my family, we have, like, I try to make my great-grandfather Morris is one example, but there are others. I try to make for my own children, who obviously never met Morris or will never meet Morris. I try to make him like a real character in their lives, so they understand how hard he worked and what he went through. It's just telling stories, man. It's like, Morris worked a whole day, and then you used to be able to make money, like a side gig basically, was candling eggs, right? Because they had to check to make sure that the eggs were not fertilized so they could sell them. So they would, if you were an egg manufacturer, egg distributor, you would, as piecework, you would pay these basically immigrants living in these tenements to take a basket of eggs home and hold each one up to the light to make sure that they were not fertilized. And then they would bring in the unfertilized ones, and then you'd go and distribute and sell those.
Yeah.
Okay. So Morris would work a full day and then come home and until late at night candle eggs until he had enough money to open his first shop, right? And then he opened more shops and real estate, blah, blah, blah. But like, that is the image of this, like, 16, 17-year-old guy who, by the way, left Ukraine and was never to see his parents again, had nothing, like sleeping in some, cramped tenement with, God knows if there was running water, right? And he's like working all day for money. And then at night, for a really long time to generate enough capital to be able to open his first business. Like, that is a powerful image to me. And I think a powerful image for my kids and hopefully for my grandkids someday.
Amen. Well, Moses, this has been wonderful. Is there any way you want people to reach out if they have questions or follow along with your journey?
Yeah, two ways that people can find me. One is on X, at Moses Kagan. The other thing, if you want to sort of short circuit that, is I have a mailing list that you can join at moseskagan.com. And I write, like, I don't know, once every couple weeks or something. And it's generally fairly in the weeds stuff about the real estate business.
You also have a really interesting real estate conference that I went to that's pretty hands-on. I met a bunch of investors, operators who are like in it. Can you just talk about that before we log off?
Sure. And I'm always terrible at doing at plugging my own stuff, so I appreciate the you teaming
I mean,
up.
It's great. It's just high value for people,
Yeah, thank you.
Yeah.
It's called Reconvene. And people can find out more about it at reconvene.com. But the idea is we bring together a few hundred active real estate operators and passive investors from all over the country, actually some in Europe and Mexico and Canada, who are interested in talking about the weird, generally sub-institutional deals that they're doing. They're, aggregating cold storage or self-storage facilities or doing small hotels and it's just a really interesting and fun crowd, and we get them together for 3 days of hanging out and really getting into the weeds about the business.
Cool. Well, I got a lot of value from it, so I definitely recommend people check it out.
Appreciate that.
Thank you, Moses. This was great.
Thank you.